W. Clement Stone famously said, "Big doors swing on little hinges." If you intend to master multifamily or commercial real estate investment, sooner rather than later, you're going to need to have a really clear understanding of how cap rate works. In this video, you'll learn what cap rate is, and I'll show you a simple trick to easily remember and calculate it. You'll also discover where to find the best cap rates to use in the neighborhoods that you hope to invest in. And I'll show you a practical, almost magical way that I sometimes use it. Oh, and don't worry about looking good. Plenty of really smart people sometimes get tripped up on cap rate. After watching this video, you'll be able to simplify it for them. And trust me, smart people appreciate simplification. So what is cap rate? Well, as you probably already know, houses are normally evaluated by comparing them with other houses just like them that recently sold. That's not very helpful with apartment buildings because it would be extremely rare to find another apartment just like the one that you're looking at that recently sold. So some people talk about dollars per door or dollars per unit. And while that's interesting, it's not very helpful either. Because when you're making an investment, what you're really doing is buying an asset that's going to produce a certain stream of income. And as you probably know, apartment buildings and any other commercial investment come in all different types and sizes. So cap rate levels the playing field by linking the value to the income that the asset produces. Let me show you a simple way to remember and calculate cap rate, and then we can talk a little bit more about risk. All you have to do is remember ERV. On a piece of paper or in your mind, draw a triangle. Separate the top half from the bottom half with a horizontal line, and then separate that bottom part by another vertical line. In the top, put an I for income. In the bottom left-hand corner, put an R for rate, and in the bottom right-hand corner, put a V for value. The way the math works is that if you know any two of these numbers, you can figure out the third. So income divided by rate equals value. Income divided by value equals rate. And rate times value equals income. The I really stands for NOI, or net operating income. Net operating income is all the revenue that you get from a property, including the rent and any other fees that you might charge for, say, laundry or parking or pets, minus a reasonable vacancy allowance. And then you take away any other expenses like property taxes, insurance, maintenance, utilities, or management. NOI is really easy to find because it's the line marked NOI on the property's income statement. Please note that net operating income, or NOI, comes before any debt servicing like a mortgage payment. The R stands for rate, or more properly, cap rate, is usually expressed as a percentage or in decimal form. I'll show you where to find those in a moment, but for now, the important thing to remember is make sure that we're comparing apples with apples. Does this cap rate come from real data from recent sales, or is it implied by a listing price, a price that's being offered for sale? Or is it a number that's just made up by a broker to show you what the property perhaps could do in a couple of years? The V stands for value. And the value is the price that a property actually sold for or might sell for if you use the appropriate cap rate. Let's look at an example. An apartment building with a net operating income of $150,000 recently sold for $3 million. With these two numbers, I can determine what the cap rate is. $150,000 divided by $3 million equals 5%. Now, if I know that the prevailing cap rate is 5% and my building has a net operating income of $150,000, I can take the $150,000, divide by the prevailing cap rate of 5%, and determine that my building is probably worth about $3 million. A third example is if you come across a property that is offered for sale at $3 million and you know the cap rate should be 5%, you can multiply the $3 million by the 5% and determine that the net operating income needs to be at least $150,000 in order for that to be a fair price. Another way of looking at this is, if the numbers are true, 1 year of income will cover 5% of the price of this property. ERV is a simple way to remember and calculate cap rate. The best way to remember this information is to gather some data, grab a piece of paper or your calculator, and run some scenarios. Now, let's get back to risk. We have said that cap rate is a measure of market sentiment. Basically, how excited, comfortable, or cautious are investors about the future prospects of any given opportunity. The factors that influence cap rate include things like the asset type. Is it multifamily, industrial, office, or other types of assets? The age and quality of the building. Buildings are sometimes referred to as class A, B, or C. A being shiny and new, and B maybe showing its age a little bit or missing some features, and C perhaps looking a little tired and might represent an opportunity to purchase that building and move it up to a B. Another factor that is looked at in cap rate is where is it located? What is the rent security, how likely it is you're going to be able to collect rent and keep those tenants, and other macroeconomic factors. Generally, a higher cap rate is a representative of higher risk and a lower relative price. A low cap rate indicates lower risk and suggests that investors see the future prospects of this type of property as being much better and would be willing to pay a higher price. So, which is better? A high cap rate or a low cap rate? Well, that really has a lot to do with your risk tolerance and what you plan to do with the building. Let's assume that you've just inherited $10 million and you're extremely risk averse. Now, while there's no such thing as a completely risk-free investment, government-backed securities come about as close as you can. You've just learned that you can get a 2% return on a T-bill account, or $200,000 a year. Why on earth would you risk your $10 million in a building that may or may not return $200,000 over the next year and will definitely require your time and attention? Would you do it for 3%, 4%? Keeping in mind that as cap rate goes up, perceived risk also goes up. The difference between a safe rate of return and the expected return from a riskier investment is called a risk premium. Now, let's assume that you're a savvy investor with considerable experience in a particular niche. You know that you can acquire that asset with a fraction of your $10 million by using leverage. You've considered all of the costs of borrowing. You've even thought about making an additional investment in capital improvements. And you have a specific plan to implement certain operational efficiencies, all with the intent of increasing income and value. You might have a different perspective. Cap rate is about the property, not the people buying it or what you plan to do with it. Remember, cap rate is a rule of thumb or a starting point. You are acquiring a labor-intensive stream of income, and you'll need to be sure that you do extensive due diligence. Would you like to know what current cap rates are so that you can compare them against asset types in different cities? Or so you can plug them into your ERV formula and instantly know what a property should sell for? Well, you're in luck. High-volume commercial brokers like CBRE provide helpful quarterly cap rate surveys. I'll provide links for both Canadian and US markets in the description below this video. Oh, and before you go, let me show you a practical, even somewhat magical way to use cap rate. We own a couple of properties with over 150 residential units each. If I'm training a new resident manager or leasing agent, one of the first things I'll tell them about is ERV. If you believe, as I do, that their job is to protect or improve the value of your asset, wouldn't it be a good idea if they knew how to do that? Cap rate. After showing them ERV, I'll say something like this. If you could figure out a way to earn an additional $10 in revenue from each one of our tenants, what would the value of this building be, assuming a 6% cap rate? They'll do the math. $10 times 150 units, well, that's $1,500. Times 12 months brings it up to $18,000. Well, that's pretty good, but wait until you divide it by that 6% cap rate. $18,000 divided by 6% gives us $300,000. Now, somebody who could do that for you would be worth a pretty generous bonus, don't you think? Okay, now compare that with a manager who says something like, my job would be easier if we just reduced the rents by $50. Well, it's only $50, right? Well, let's do the math again. So $50 times 150 units times 12 months divided by 6% is 1.5 million. Now, which manager would you rather have stewarding your investments? Big doors swing on small hinges. There's more to say about cap rate, and I'd be happy to help you out if you reach out to me. I'm Jeff Gunther. Making money is simple, but life can be hard. The good news is you don't have to do it on your own. Please subscribe and share this video.